This is Nightly Business Report with Bill Griffith and Sue Herrera.
What a week. A dramatic sell-off and a jolt of volatility left heads spinning. So what happens next and what money moves should you consider making?
Big bank earnings results are in from J.P. Morgan, Wells Fargo, and Citi, but it's what they're saying about the economy, interest rates, and trade that's getting all of the attention.
The new subprime, no down payment, low interest home loans. Sound familiar? They're back, and they have the support of a major bank. Those stories and much more tonight on Nightly Business Report for Friday, October 12th.
And we do bid you good evening, everybody, and welcome. Well, that was interesting, wasn't it? I mean, for many, it was a stomach-churning week on Wall Street that ended today with gains. That allowed investors to take a much-needed breath and digest what had happened over the past 2 days. The sharp drop in the Dow, 800 points Wednesday, 500 points Thursday, was certainly the talk of investors around the world because the selling was sharp and swift, and it was unclear when it would end. But today, the selling did end, at least for now. The Dow climbed by 287 points to 25,339. The Nasdaq was up 167. The S&P gained 38. And look at the losses for the week. It was the biggest weekly decline for stocks since late March. And what a 5 days it was. The signs were there. Trade tensions and that sinking feeling about U.S.-China relations. Tech stocks, the high flyers, losing altitude, bond yields at 7-year highs, and a Fed determined to hike interest rates. Stocks came out swinging on Monday, down 200 early on, then up in the afternoon. Ultimately, the Dow finished up only slightly. On Tuesday, interest rates took center stage. Autos and homes have been getting more expensive. 30-year mortgage rates touched 5% for the first time in 8 years. Stocks drifted lower. Late in the day, President Trump weighed in on the Fed's rate hikes.
The Fed is doing what they think is necessary, but I don't like what they're doing.
On Wednesday, the president continued.
I think the Fed has gone crazy.
He also said the Fed is going loco, and stocks went loco, their biggest decline in 8 months. The Dow falling more than 800 points. And Thursday,
the red arrows are back, and they're back with a vengeance, too.
The Dow down about 2% as we approach the close.
Down more than 500 points for a 2-day decline of 1,300 points. 3/4 of the S&P 500 touched correction territory, down at least 10%. And finally today, more volatility, a bounce higher, up more than 400 points, but then down briefly. Finally then, up more than 280 points.
So let's turn now to Jason Draho to talk about what's next for this market and what moves you should be making, if any, in your portfolio. He is head of America's asset allocation at UBS Global Wealth. Welcome, Jason. Nice to have you here.
It's good to be here.
You know, even for the pros on Wall Street, this was a day and a week, as Bill just outlined in his package, that really had heads spinning. So for the average investor, what's your best advice on how to really weather what looks like it's going to be quite a volatile period?
Well, the preceding story kind of alluded to two factors that caused this, the market gyrations this week. One was the move higher in interest rates. The other is trade. But when we look at what's happened over the past week, this feels very reminiscent of what happened earlier this year, back in January and February, where there was a correction similar to this. It took a couple of months for the markets to stabilize, and then they kind of continued to move higher. I think the reason that happened before was because the economic fundamentals in the U.S. were very solid. And in the U.S. right now, that's still the case. Nothing over the past 2 weeks suggests that the economy has gotten any worse. In fact, the economic data from last Friday on the jobs numbers over the past 2 days on inflation suggests the U.S. economy is doing very well at this point in time. That gives us confidence to suggest once we get through some sort of gyrations, the bull market should continue.
There are a lot of people watching who invest for income, whether it's in a fixed income portfolio or in equities of some kind. But rates are rising, and that's causing stock prices to go down. What's the average investor to do with that kind of scenario, do you think?
Well, the rate rise has given investors who haven't invested in sort of fixed income securities a chance to invest at higher yields and higher returns. But for the stock market, anytime you have a large move in interest rates like we've seen over the past couple of months, it takes a little bit of time for the markets to digest this, to adjust, and then to sort of reset. So I think for investors, and the way we kind of think of it, this is an opportunity to perhaps actually add back to equity market risk. Even if you're looking for income, there's opportunities in dividend-paying stocks. And this correction has actually given an opportunity to reduce valuations and make it a little bit more attractive in certain segments of the market.
Should investors, very quickly, Jason, prepare for more volatility? For those who are not the pros on Wall Street, for those who are sitting and watching this program at home and saying, I don't know what's coming next, what should they do?
So I think we're at a stage of the economic cycle where we're going to get these kind of periodic bouts of volatility in the markets. I think one of the best ways that investors can deal with this and not kind of get overcome by the emotions and sort of react too quickly and maybe want to sell or buy when they shouldn't is to make sure they have clear long-term goals and think about their portfolios trying to achieve different objectives. So one example is to have a segment of your portfolio for liquidity needs. Make sure it covers all your expenses and cash flow needs for the next, say, 3 years. Invest it in sort of safe, kind of short, cash or fixed income assets. There's very little risk to that. Mm-hmm. And then think another segment of your portfolio, investing for the long term, for your retirement needs, for kids' education, things of that sort. And that segment of their portfolio, you can invest in equities and other riskier assets. That way, by segmenting this way, when you get these kind of drawdowns and market corrections we've seen over the past week, right, it's confined to your longevity portfolio, and you don't have to worry about it touching your short-term kind of cash flow needs. And we find certainly with our investors, when they take this approach, just sort of divide it that way, it helps them ride through these periods of volatility much more easily, and they don't make sort of emotional decisions.
Very good advice.
And so that's kind of one thing that I think investors kind of try and do.
Jason, thank you. Jason Draho with UBS Global Wealth.
My pleasure.
Well, earnings season did get underway in earnest today, and as we've been reporting, this season is shaping up to be a bit more complicated given the extreme market volatility and issues like rising rates, higher raw material costs, and trade tariffs. Today, J.P. Morgan, Citi, and Wells Fargo started us off, 3 companies from one of the market's biggest and most critical sectors. Leslie Picker has our results tonight.
Amid the market volatility this week, investors today were focused on the third quarter earnings from the 3 large banks for clues about what their results say about the economy, interest rates, and lending as a whole. J.P. Morgan beat analysts' estimates, while Citi and Wells Fargo posted mixed numbers relative to Wall Street consensus. On a call with analysts, J.P. Morgan CEO Jamie Dimon and CFO Marianne Lake spoke optimistically about the firm and the economy, and J.P. Morgan's results seem to support that. As one analyst wrote this morning, quote, "Always tough to call the end of the cycle, but there's no evidence of the end in J.P. Morgan's results." On the analyst call, Dimon was brushing off concerns about rising interest rates, saying that investors need to look at the reason why rates are rising, not just the fact that they are rising.
The why is more important. Are you still growing? The economy is strong. Rates are going up. Most of us consider a healthy normalization and going back to a more of a free market when it comes to asset pricing and interest rates, et cetera. And we need that. So to me, overall, it's a good thing, particularly because the economy is strong. And so I do expect rates will continue to go up.
On the media call, Dimon highlighted specific risks, including Brexit, trade, reversal of QE, and international tensions in Italy, Turkey, Argentina, and Saudi Arabia. Dimon called these headwinds, quote, geopolitical issues bursting all over the place, but said he didn't think they would derail the U.S. economy. Both Citi and Wells Fargo have been focused on their own plans to bring down expenses, but also showed through their own earnings that the rising interest rate environment is still benefiting their bottom lines. Rising interest rates can help banks because it allows them to earn more on interest on the loans they make. But there is a point in the cycle where banks no longer benefit, when consumers and businesses stop taking out as many loans as they were before. Analysts and investors don't see evidence of that quite yet, at least based on the reports from the first 3 major U.S. banks to share their third quarter results. For Nightly Business Report, I'm Leslie Picker.
The Treasury Secretary today said he is not concerned about the sharp pullback in the market this week, simply because the economy is so strong.
Well, I think the fundamentals are still very strong. The U.S. economy is strong. U.S. earnings are strong. So I see this as just a natural correction after the markets were up a lot. There's really no new information in the market on the Fed or on trade, for that matter. So I really see this as a reaction of markets tend to go too far in both directions, and they have natural corrections.
The Treasury Secretary also said that the White House respects the independence of the Federal Reserve and that when the president criticized the central bank this week, he was just expressing his concern about interest rates rising too quickly.
Well, one of the things that's working in the market's favor are the buybacks by corporations. Here's why. Buybacks occur when a company repurchases stock, obviously. That reduces the number of outstanding shares and could potentially increase earnings per share. Well, a large number of buybacks are expected, and that could be good for the broader market. Bob Pisani has details.
Buybacks have been one of the big stories supporting the markets this year. DataTrek estimates that in the last 12 months, the companies in the S&P 500 have repurchased $646 billion of their own stock. That's about 30% more than the year before. And there's plenty of dry powder that's left. One firm told me there's at least $350 billion in unused buybacks just waiting to be put to work. More than 300 large-cap companies have active buyback programs, including Apple, Amgen, Visa, Applied Materials, Google, many more. Contrary to popular belief, companies can buy back stock during blackout periods in the period just before their earnings are released, providing the companies have set up a plan to buy back stock on a regular, defined basis. Now, there are certain restrictions, like not being able to buy in the last 10 minutes of trading. Corporations typically seek to buy back a certain amount of the dollar value of their stock on a daily basis. So with prices down, corporations can buy back more stock, and they may even get more aggressive if prices drop more. So when is this going to end? When will companies stop buying back stock? Right now, they are generating enormous amounts of free cash flow. Unless companies can find an attractive use for all that excess cash, dividends, for example, and M&A does compete with buybacks, I'm betting companies will still funnel the majority of their excess cash to buybacks. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
It is time to take a look at some of today's upgrades and downgrades. Microsoft was upgraded to outperform from neutral at Macquarie. The analyst cites the company's earnings power and the decline in the stock price this week. The price target is $121. Microsoft shares rose 3% to $109.57. Netflix was upgraded to buy from neutral at Citi. The analyst cites the company's strong fundamentals and the recent pullback in the stock price. Netflix reports earnings on Tuesday, by the way. The price target is $375. The shares rose more than 5% to $339.56.
Square was upgraded to buy from hold at Canaccord. The analyst there says the company is well run. He sees long-term potential. Price target now $90. Shares of Square popped by 7% today to $73.97. Estee Lauder was downgraded to neutral from overweight at J.P. Morgan, with the analyst citing concerns about the impact of the U.S. trade dispute with China on Estee Lauder's business. Price target $138. Estee Lauder's shares fell 1% today to $126.32.
Still ahead, 3 stock picks our market monitor says you should buy and hold to get you through these volatile times.
While emergency crews search through the rubble left in Hurricane Michael's deadly path, analysts are starting to do what they do after natural disasters, and that is tally the damage. One early estimate puts the cost at $8 billion. Others, though, say that figure could still rise. The storm left a trail of destruction, as you know, stretching from Florida to Virginia. Mexico Beach and the Florida Panhandle, for example, was one of the hardest hit areas, with entire blocks of homes just obliterated. Overall, more than 1 million residents remain without power.
Back to the market and the economy now, where interest rates and wild market swings aren't just being talked about on Wall Street, but across the country. And tonight, Brian Sullivan spoke to a businessman in Houston to get his view on borrowing, the consumer, and the state of the American economy.
With the recent stock market volatility and interest rates on the rise, there's been a lot of questions about whether or not the market, either the stock market or the bond market, is telling a negative story about the American economy. Will the U.S. economy slow down because of rising rates? Is the economy headed in to some kind of recession, perhaps, next year. A lot of speculation. The best thing to do is go right to the source of the consumer, and that is speaking with Tillman Fertitta. He is the chairman and CEO of Landry's. They're one of the biggest privately held companies in the world, own more than 600 restaurants, a bunch of casinos, as well as the Houston Rockets. And we asked him, are you seeing any slowdown in the consumer at your restaurants or hotels?
The consumer is out there spending money. And what you're seeing in the stock market the last couple of days is just little corrections that you have to have when the market's up 300% in the last 8 years. So they're out there, they're gambling, they're buying cars, and they're buying food. Nobody worry about a thing. The economy, all the catalysts that make the economy strong are still there. It's going to be good for a good while.
So Fertitta not seeing any kind of a slowdown yet, but he does caution that as a builder, and he built the hotel that we are sitting in right now, interest rates, certainly as they rise, do matter, especially if you're spending a couple $100 million on a development.
When you start talking about $100 million, 1% is a bunch of money. It definitely has an effect. And that's why America's grown and capitalism in America has been so great the last few years, because interest rates have been low. Let's not screw it up and raise them too fast.
He's optimistic, obviously, but he is cautious about interest rates. And certainly when you're building a multi-$100-million hotel, any kind of rise, like Tillman said, certainly does matter. So I think the idea being the stock market may not necessarily reflect the American economy right now, which by all measures is still going very, very strong. But if rates keep rising, and if we see the price of oil, by the way, keep rising, it could be a hit on the U.S. consumer, especially in a place like Houston, Texas. For Nightly Business Report, I'm Brian Sullivan, Houston, Texas.
Ford sales fell sharply in China, and that is where we begin tonight's market focus, with the automaker reporting a 43% decline in sales in the world's largest automobile market in September. It is the third straight month of declines. Auto sales in China overall dropped the most in nearly 7 years. Analysts say that they are concerned that Chinese demand for cars could contract for the first time in decades as economic growth there continues to slow. Ford shares fell nearly 2% today to $8.64. PNC Financial today reported a rise in quarterly profit, but loan growth was disappointing. Investors are expecting to see lenders, especially regional banks like PNC, benefit from higher borrowing by businesses as those firms take advantage of their new lower tax rate. PNC shares, though, were off more than 5% today to $124.26. General Electric has delayed the release of its third quarter results by almost a week. Company says it will give the new CEO, Larry Culp, more time to review its businesses. A J.P. Morgan analyst today, though, argued that the company did not have enough assets or cash flow to pay down liabilities. Shares of GE fell 3% today to $12.32.
Bristol Myers' blockbuster cancer drug Opdivo was being tested on lung cancer, but it failed to meet the main goal in the late-stage trial. The study was being done on patients with an aggressive form of the disease whose condition had relapsed after chemotherapy. Shares were basically unchanged, up a penny to $57.51. Software company Anaplan soared in its market debut. The CEO said he did not consider delaying the IPO amid the market rout this week, mostly because he says the outlook for his business is strong.
We have almost 1,000 customers, and those customers have been with Anaplan, and we're adding a large new number of customers on a regular basis. So I was looking really at the future of Anaplan and how that can be positioned. I think things worked out quite well for us over the last 2 weeks.
Anaplan shares soared 42% on their first day of trading. They closed at $24.30.
Now to our weekly market monitor, who has names of stocks that he says you'll want to own for the next 3 years. Now, the last time he was with us in April, he recommended Amazon, which has risen 15% since then, Facebook, which is down 8%, and Salesforce.com, which is 18% higher. Mark Lehman is back with us. He's president of JMP Securities. Mark, good to see you. Welcome back.
Thanks for having me.
Let's get to these three stocks tonight that are really very relevant, I think. Upwork is your first stock tonight, a freelancer platform, which I guess would benefit from the tight labor market we see right now, yes?
That's exactly right. It is the best play on the freelancer market. They also are in the highly skilled labor market, which is highly in demand, and they match talent with companies that need that talent, and it is a very high-growing market as well as an international market. And given globalization, that is where you want to be. And this is a great company that recently went public, but for the next few years, this is going to be a name you want to watch.
Quickly, not worried about that 9% decline this year?
Well, Upwork went public recently. I'm not worried. It's a new company. It will be volatile because it's a couple $1 billion market cap. It's not a mega company. But over time, this is the best player in that space, and you're going to want to own it because it is the best player.
From a tight labor market to a tight housing market, especially on the entry level, this stock has been hit with the rest of the home builder stocks. But you like LGI Homes. Why?
I do. It's an entry-level player in some high-growth markets in the South. They are the low-cost producer. We all know that the home building stocks have been hit very hard. This stock is off 50% from its highs. Fundamentals remain intact. There will be gyrations when rates rise, but I think over time, this entry-level market, and they're the best at it, is where you want to participate. Again, the stock's down 50%. I see big upside in the next 3 years.
Last time we were with this, you liked Amazon. Tonight, you still like Amazon. Why?
Well, it is up since the last time we recommended it. It's also down about 15% from the recent highs. And I think fundamentals haven't changed. You have a dominant market share leader. You have a high-growth business in what they're doing in the cloud and other areas. They're clearly playing in the highest of growth markets. You got a 15% off sale recently in the stock. And you don't get often the best companies trading for a 15% discount than recent highs. And I think this is just when people have been waiting to add their portfolios. This is the time.
All right, and again, these are recommendations that you feel are good for the next 3 years or so at that point. Mark Lehman from JMP Securities. Again, thanks for joining us tonight.
Thank you both.
And to read more about Mark's picks, you can head to our website at nbr.com.
Coming up, potential borrowers with poor credit are being offered no down payment, low interest rate loans. Sound familiar? Facebook issued an update on the security breach announced last month. The company says the hackers stole name and contact details from 29 million users. That's less than Facebook's original estimate of 50 million. The social media network is cooperating with the FBI, which is actively investigating that attack.
There are reports tonight that Sears is going to file for bankruptcy on Sunday. And as part of a deal with lenders, it will receive an emergency loan of $500 million from a group of banks. And then, according to Dow Jones, the retailer will close all but 300 of its stores, giving it a smaller, more manageable footprint. Sears was scheduled to make a major debt payment of $134 million on Monday.
Well, you probably remember that after the housing crisis, lenders tightened up dramatically and did away with those subprime loans that went to borrowers with low credit scores. But now there's a new program appealing to subprime borrowers with offers of no down payments, low interest rate loans, and it's backed by a very big bank. Diana Olick is in Miami tonight.
Magdalene Altador wanted to be the first in line.
I left home, it was about 4 o'clock this morning.
First to apply for a no down payment, low interest mortgage at a special 4-day event in Miami.
I did own a home in the past. I went through foreclosure and I'm ready to purchase a new home.
No down payment, right?
The event is one of several being held in cities across America this year, run by the nonprofit brokerage Neighborhood Assistance Corporation of America, or NACA.
It's a national disgrace about the low amount of home ownership, mortgages for low and moderate income people and for minority home buyers.
The only real solution is to restructure your mortgage, right?
In 2010, Marks and NACA were front and center during the foreclosure crisis, holding mass mortgage modification events across the country with banks and servicers. Bank of America was there then.
So this will be the only thing today that will be of concern.
And Bank of America is here now, backing NACA's home ownership drive with $10 billion in mortgage commitments.
Do you see any risk to Bank of America?
No, it's total upside. We have seen significant wins in this partnership. I mean, just to be clear, when we get those loans with all the heavy lifting that the team does here, we're over a 90% approval.
Borrowers can have low credit scores, but they have to go through an education session about the program and submit all necessary documents, from income statements to phone bills. Then they go through counseling to understand their monthly budget and ensure they can afford the mortgage payment. The loans are 15 or 30-year fixed, with interest rates below market, about 4.5%.
That's what's going to help people who've been locked out of homeownership to really become homeowners and to build wealth.
Critics of the program argue that with no down payment, no skin in the game, these borrowers have no reason not to walk away should their homes lose value. That's what happened during the financial crisis. The difference here is that none of them are investors. In order to get the loan, they have to live in the home.
Working people look at their investment in homeownership for their family, for their neighborhood, for themselves.
Having her home, let's say 10, 15 years from now, that's an investment. Home ownership, freedom.
For Nightly Business Report, I'm Diana Olick in Miami.
And to read more about subprime mortgages, you can always head to our website, nbr.com.
Finally tonight, a piece of American history is up for sale. The home of John Proctor. He was one of the 19 people executed during the infamous Salem witch trials in 1692. It's on the market in Peabody, Massachusetts. Has 6 bedrooms, 2 baths, and the whole house has been modernized, as you can see. The asking price, $600,000. However, you're probably going to have some stiff competition for this because a local historical society is said to be interested in buying the home and turning it into a museum. Probably a good idea.
Indeed. Favorite story of the day. Before we go, here's a look at the final day on Wall Street. The Dow climbed 287 points, NASDAQ up 167, S&P 500 added 38. But for the week, the major indexes had their worst decline since late March. What a week.
Indeed.
That does it for us tonight. Thanks for joining us. I'm Sue Herrera.
I'm Bill Griffith. Have a great weekend. See you Monday.